Welcome to the channel. We bring you the latest international news from around the world. Today, we're going to dive into China's record $53.3 billion in bond sales in the first quarter of 2024 and their significant implications for the U.S. economy. Let's take a look at how these sales could potentially change the economic landscape. China's bond sales are part of its strategy to diversify its investments and reduce its reliance on U.S. assets. These sales include U.S. Treasuries and agency bonds, which could have a chain reaction throughout the U.S. economy. First, China's sale of these bonds could cause long-term interest rates to rise. When China gets rid of its bond assets, the supply of these securities in the market increases, potentially raising their prices and yields. Experts estimate that a 30 basis point rise in 10-year Treasury bond yields would be problematic but manageable in the short term. However, with longer-term exposure, the consequences could be more severe. On the other hand, higher U.S. rates compared to still low European rates could attract private funds into the U.S. fixed income market. Second, China's bond sales could affect the value of the U.S. dollar. As China sells its dollar assets, we may see the dollar depreciate against other major currencies. This scenario has a double impact on the U.S. economy. On the one hand, a weaker dollar could boost U.S. exports, making them cheaper for foreign buyers, potentially stimulating economic growth. On the other hand, a weaker dollar could increase the cost of imports, leading to higher inflation and negatively impacting consumer spending and economic growth. Third, these sales could affect the Federal Reserve's monetary policy decisions. If China's bond sales could increase the value of the dollar and make things more difficult for the U.S. economy, the Fed could slow the pace of rate hikes or reduce quantitative tightening or balance sheet reduction. This could have significant implications for the overall direction of the U.S. economy, as the Fed's actions have a profound impact on interest rates, inflation, and economic growth. Therefore, any changes in its approach due to China's bond sales are important to monitor. Finally, China's bond sales could affect the U.S. government's ability to finance its debt. As China's assets decline, demand for U.S. Treasury bonds could decrease, making it more difficult for the U.S. government to finance its debt. This could lead to higher interest rates and increased borrowing costs for the U.S. government, with long-term implications for the U.S. economy. To summarize, China's record bond sales have serious implications for the U.S. economy. While it is difficult to predict the exact impact, we can expect it to have a significant impact on long-term interest rates, the value of the U.S. dollar, the Federal Reserve's monetary policy decisions, and the U.S. government's ability to finance its debt. Ultimately, it could reshape the economic landscape of both countries and even the world. Thank you for watching. Don't forget to like, share this video, and subscribe to our channel to get more in-depth analysis and breaking news from around the world. We wish you prosperity and well-being.